Good morning, ladies and gentlemen. The title of my presentation, An Introduction and Overview of Double Taxation Agreements, I think really doesn't do the subject of DTAs justice, because there's a huge amount of jurisprudence that has built up over the years on DTAs, and we really could spend certainly not just the whole of today talking about it, but probably the whole of this week and the whole of next week. So all I'll be doing in 45 minutes is really scratching the surface at best and hopefully clarifying some of the concepts that are used in DTAs and explaining how DTAs link in with the withholding tax legislation that my colleague ran through with you earlier on this morning. In terms of what I'm going to cover, I've split this, when I can press the right button, into 5 points. These are, first of all, double taxation agreements in terms of an overview. What are they? Secondly, I'll talk about permanent establishments. I think perhaps if I ask many of you here, one of the concepts that you might be most familiar with in relation to DTAs is that of PEs. Thirdly, I'll talk about business profits and how these are tied in with the concept of permanent establishment, and how in order that the business profits of a non-resident are subject to tax, that non-resident needs to have a permanent establishment. I'll go through some of what I might describe as the more substantive provisions, those typically that interest tax planners, that give withholding tax cuts in relation to interest, royalties, dividends and technical fees. And then, time permitting, I'll just make some brief comments on the Section 4F withholding tax, the other income. If we look at DTAs, I think it's perhaps fair to say that these have 3 objectives. The first objective, perhaps rather unimaginatively, is to achieve relief from double taxation. And double taxation arises because companies tax income in different ways. Some countries tax on a source basis, some countries tax on a residence basis, a lot of countries mix the two. So you quite often end up with somebody deriving income from one country and being subject to tax on the income in that country. And then when they bring it back to their home country, they're also subject to tax. So in the absence of double taxation agreements, it could be very costly to earn a return. The way double taxations go about achieving relief from what would otherwise be double tax is by sorting out or allocating taxing rights between countries. And this is the second objective of double taxation agreements. And these 2 points, or these 2 objectives, are the focus of what I'll discuss today. The third point is to combat the evasion of tax. Now, as evasion is illegal, I'm sure that's not really something that we need to spend much time talking about today. But the way that double tax agreements cut down the evasion of tax is typically through an article called the Exchange of Information article, which allows governments to pass across information about taxpayers. I think we've probably all seen this recently with the German government looking at, I think it was Liechtenstein. Any commentary on double taxation agreements would not be complete without a mention of the OECD. The reason for this is that the OECD has come up with a model double tax agreement. And in many cases, it is this model that forms the basis of the DTAs that are adopted by relevant countries. The OECD model has undergone a number of reforms over the years. It's been around for quite some time, and there are various changes that have gone through. I mean, perhaps when I was looking at it the other day, I thought perhaps one of the most recent changes is that it no longer uses Roman numerals. Instead, it uses a normal 1, 2, 3. And it's interesting to note that Malaysia, although it's not strictly a member of the OECD, it has followed the OECD model for treaty purposes. The basic way in which the OECD agreements work is to allocate taxing rights, in that the country of residence of the taxpayer is required to either grant a credit or an exemption. If you look at, for instance, Article 24 of the Malaysia-UK agreement, you will see that the UK is required to grant a credit for Malaysian taxes. The other side of the coin, so from the country of residence granting a credit or exemption, the other side of the coin is for the country of source to either reduce the scope of its taxes or to cut or reduce the rates of its withholding tax. And we'll look at some of the rates in a while. If we're going to look at DTAs, I think, as with most things in life, the best point to start is at the beginning. So if we look at what the preamble says, and this could be from any of Malaysia's double taxation agreements, but you'll see that it says that a DTA is an agreement between the government of one contracting state, it could be the UK, it could be Australia, it could be wherever, and the government of Malaysia. So it tells you, first of all, that double taxation agreements are agreements between governments, not between states or counties or provinces. And it also sets out the purpose. DTAs are for, one, the avoidance of double taxation, and secondly, the prevention of fiscal evasion. Okay? So you can see there's really two purposes: avoidance of tax and fiscal evasion. I think the important point to note from this is that double taxation agreements cannot impose tax. Okay? They cannot impose tax. Which I suppose, as a little anecdote, raises the question: if double taxation agreements cannot impose tax, then what is international tax? Perhaps it's a bit of a misnomer. After all, you don't really pay any international tax. You either pay tax to the federal government or you don't pay it. But the key point is that DTAs cannot impose tax, and therefore, if you are looking at whether relief is due or not, your starting point is to always go to the domestic law. If under domestic law there is no tax liability, then the double taxation agreement cannot make things worse and impose a tax liability. Okay? And this is sometimes something that catches people looking at DTAs for the first time off guard on. Because, for instance, if you take a lot of Malaysia's agreements, there are provisions in there restricting the rate of Malaysian withholding tax on dividends. And from my tax knowledge, as far as Malaysian withholding tax on dividends is concerned, it's something in the region of kosong. Okay? I believe dividends are exempt under the single tier system. Okay? So if you read the double tax agreement, you might see, 25% withholding tax. Okay? So you go back to domestic law, there's no withholding tax, therefore you don't have to worry. The reason the DTAs have these rates is to cater for subsequent changes in law, because it takes quite a long time to actually agree and negotiate the terms of a DTA. So usually the people drafting it are sufficiently wise to want to be able to cover their bases, so that in the event of future law changes, everything is there already. If we look at the OECD model, you can break its structure down into half a dozen or so groups. I mean, there's the scope, the general definitions, the substantive bits of the DTA that deal with the reductions in tax, the supportive provisions, special provisions, which is perhaps a bit too detailed for today. And one point that I would like to bring your attention to, that under the final heading, which relates to entry into force. Often these DTAs require a number of steps before they become law. So what you have to watch out for when you're relying on the DTA is, first of all, that the DTA has actually become law, and secondly, that the article that you're going to rely on has itself become law. Often there's a mechanism that will say, this article shall become effective 1st January of the year following which the treaty becomes effective. Okay? So you have to watch out to make sure that you really are relying on something that's working. If we look more closely, in terms of a comprehensive DTA, you will invariably find that there are a number of commonly recurring articles. One of the things that you always find in a DTA is details in one of the opening articles of what are the taxes covered. And this is quite important because typically you'll find Malaysia's agreements cover income tax and often petroleum income tax. But in my experience, I don't think I've ever found a DTA that covers RPGT. So it's always worth looking at the scope. There will inevitably be a general definition section. Residence is a key part of any DTA, as in order to be able to use a DTA, you must be a resident of one or other of the territories. Permanent establishment is very common. Permanent establishment, as I mentioned at the start, is linked with business profits, because typically the way a double taxation agreement works in relation to business profits is that it says that the income or profits of an enterprise of one of the contracting states shall not be taxed in the other contracting state unless there is a permanent establishment in that other contracting state. So there's a very close link between permanent establishment and business profits. There will also be articles dealing with royalties, interest, technical fees, and generally there is an other income article. I think if we start by looking at the general definitions, I mean, it may seem fairly obvious, but sometimes it's worth having a look at what is the scope of the territory covered. I mean, for instance, I put the illustration on the slide of France. Now, to many of us, France may be that block of land to the south of England that was cut off from England at the end of the last ice age. But if you actually look at the definition, you'll see that France is defined to include Guadeloupe, Guyana, Martinique, and Réunion. And this in itself is not just of passing academic interest, but where this can become very relevant is if you are looking at, say, the airline profits article. You might have an airline that is flying to somewhere like Martinique or Réunion, and you might hunt, as I once did, for a treaty with Martinique or Réunion, only to find that it's actually included within the definition of France. So it's always important to look at the definition section of the DTA. And there are a number of other countries that have a fairly extended territorial definition. I mean, for instance, if you look at Australia, that defines Australia to include things like Christmas Island and the Coral Sea Islands. And I think if you look at one of our more recent treaties with Spain, between Spain and Malaysia, that defines Spain to be the existing sovereign territory of Spain and any future sovereign territory that Spain may claim as its. I thought it was quite an interesting definition. Okay, residence, I just mentioned a minute ago. Residence is vital because if you are not a resident, you just cannot rely on the treaty. Residence typically will follow the domestic law definition. Not always, but you'll often find that in the residence article, you're thrown back to the domestic law. And it's worth just sort of thinking how this could work. You imagine a Malaysian branch of a Japanese company doing business with, say, a UK company. Then then the treaty that you would want to use is obviously the UK-Japan treaty. Because although you might be a thriving Malaysian business, as a branch, you are not a Malaysian resident, and therefore you don't qualify under the Malaysia-UK. So this is something that can get overlooked on occasion. The residence is also important, not just to gain entry to the treaty club, but also in terms of the credit given under the treaty will only be given to a resident, and the reliefs offered under a treaty will only be available to a resident. Okay, the concept I want to look at now is permanent establishment. This is one of the most significant concepts in any DTA, any comprehensive DTA, because it's only when a non-resident has a permanent establishment in a country that that country can tax his business profits. So for instance, if I as a resident of Malaysia go, say, to Australia for a couple of days and stay in an hotel and sign a contract and then come back to Malaysia, Australia should not be able to tax me on the income attributable to that contract on the basis that I was only in Australia for a couple of days, and therefore, although I signed the contract in Australia, I did not and do not have a permanent establishment. So you can see, or you can imagine, that where PEs are involved, you can often be talking about quite substantial sums of money. The starting point in terms of definition of a PE is that a PE is a fixed place of business through which the business of an enterprise is wholly or partly carried on. And I think there are a number of important points in this definition. First of all, the PE must be fixed. Therefore, in my earlier example of a couple of days in an hotel room, that would hardly be fixed. There are various cases. There's not a lot of Malaysian jurisprudence, but there's a lot of jurisprudence involving OECD countries in terms of what constitutes fixed. And on the basis that most countries are following the OECD model, decided case law in other countries should be relevant if the issue ever arises in Malaysia. So a PE is a fixed place of business through which the business of an enterprise is wholly or partly carried on. And so as part of this definition, there is the issue of whether what you're doing actually constitutes an enterprise. You see, some taxpayers have argued that what I'm doing in the overseas country is part of my enterprise, but I don't have a fixed base, and therefore any profits attributable cannot be subject to tax. And there's a very well-known Australian case, that of Teal's case, in which a resident of Switzerland sold, first of all, units in a unit trust and then acquired shares in an Australian company, and then went on to sell those shares in the Australian company and, perhaps needless to say, made a substantial gain. And the Australian tax authorities tried to tax the person in question, Mr. Teal, on that gain. And what Teal argued, and interestingly was accepted by the courts in Australia, was that what he was doing in terms of buying and selling the unit trusts and then buying and selling the shares amounted to an enterprise, but that he did not have a permanent establishment in Australia. And therefore, the Australian Taxation Office, the ATO, could not tax him. It's quite a solid case, Teal's case, but it's certainly an interesting case to have a read. Okay, moving on from a fixed place of business, a PE is also defined to include a place of management, a branch, an office, a factory, a workshop, a place of extraction or natural resources, and a building site or construction, assembly projects, etc., extending for certain periods of time. And as you would have heard from my colleague this morning, where a non-resident contractor is deemed to have a permanent establishment in Malaysia, then withholding tax under section 107A becomes relevant. People have asked me, shouldn't the DTAs override 107A? But to my thinking, 107A is entirely consistent with the existence of a PE, because the double taxation agreements recognise that once you have a permanent establishment, then on the attributable business profits of that permanent establishment, you are subject to tax in the examples we're looking at, Malaysia. So you won't find that double taxation agreements cut back or displace the Section 107A withholding tax obligations. Aside from the PE definitions that I mentioned earlier, some of the DTAs have extended PE definitions. I mean, one of the ones that we should perhaps look at is that in the Australia-Malaysia DTA. There is some background to this. I mean, if you can cast your mind back, and perhaps some of you are not sufficiently old that you can, but if you can cast your mind back to 10 plus years or so ago, my apologies to those of you who would have been at college then. But if you cast your mind back 10 years or so ago, you may remember that the Australian residents were getting particularly aggrieved when they were hit with withholding tax under Section 109B. This, you would have heard from Stephanie this morning, is the withholding tax on technical fees. The reason the Australians were getting upset was because you had the Malaysian government saying technical fees paid by a Malaysian resident to a resident of Australia are subject to this withholding tax, but you had the Australian government saying to the Australian payee, we're not going to give you a credit for that Malaysian withholding tax because as far as we are concerned, that income is not Malaysian source, it's Australian source. And you can see some degree of logic in their reasoning, although it's quite hard for taxpayers. And what happened in the very late 1990s, there was a long round of talks between the Australian government and the Malaysian government, and eventually it was agreed that Malaysians will not levy Section 109B withholding tax on payments to Australians. But I think as part of the bargain, the overall definition of permanent establishment was extended. You'll see that in the case of the Australia-Malaysia DTA, the permanent establishment definition has widened to bring within the PE net technical services performed for 3 months or more in any 12-month period. And what I understand from a number of people in practice is that it can be quite easy to infringe this 3-month period. Because by the time you've actually, if you're a large corporate, by the time you're aware that you've got some Australian residents here doing some work, it's very easy to trigger this 3-month threshold. But I think that was sort of part of the bargaining between the two governments. Another point to note is that the Malaysia-Australia DTA also includes within its PE definition that of substantial equipment. So if a resident of one state has substantial equipment in another state, then that's deemed to be a PE. Now, what I find there seems to be a lack of authority on is what is actually substantial equipment. Do you measure it just looking at the person? So for me, my rather battered car might be quite a substantial asset. Or is it a more objective test? But it seems to be a lack. I think one would have to use a certain degree of objectivity and perhaps go back to this idea of a fixed base. Okay, moving on to some of the substantive provisions in terms of those that cut the rates of withholding tax. What I want to run through fairly quickly are the provisions that deal with interest, royalties, technical fees and dividends. And I lump them together because the provisions all are fairly similar. They move in a fairly similar direction. I mean, they all, typically you'll find that the provisions in the DTAs offer reductions in the rates of withholding tax. I think it's important to remember when you're looking at these articles that you always take the lesser of the domestic rate or the rate offered by the treaty. Because what we've seen in recent years is some of the Malaysian domestic rates of withholding tax come down and are now below the rates offered by treaties. But you would use the domestic rate. You wouldn't use the higher rate under the treaty. When we're looking at reductions in withholding taxes generally, so going beyond Malaysia, looking at other countries, a number of countries, although their treaties may offer reduced rates, they will not apply those rates automatically. There will be a system of approval. I think in my experience, Malaysia seems to be pretty automatic. You look at the IRB's website. And I think what's important is that where you're trying to use a treaty to reduce the rate of withholding tax, the payee is invariably going to have to provide the payer with a certificate of residence to prove that the payee is resident in the treaty partner country. If we look first of all at withholding tax reductions in relation to interest, you'll find that double taxation agreements typically will provide a rate that may be below the domestic rate. The alternative is to provide for an exemption. Now, in my experience with Malaysian DTAs, I think I've always found that Malaysia is offering a reduction in rates rather than in the sort of odd case an exemption. In order to qualify, so for the payee to be able to claim the reduced rate of withholding tax, invariably the payee must be the beneficial owner of the interest. And you'll see this concept of beneficial ownership running through the interest article, the royalty article, dividend articles, and technical fee articles. And we'll talk about this more in a few minutes, and I'll run through one of the leading cases on the concept of beneficial ownership. There is also the requirement in Malaysia that the payee provide a certificate of residence to the payer where they're relying on a reduced rate of withholding tax. Now, often where DTAs offer reduced rates of withholding tax on interest, the DTAs will contain what one might describe as effectively anti-avoidance measures. The first measure, which is very common, provides that the reduced rate does not apply where the interest exceeds an arm's length arrangement by reason of a special relationship between the payer and the payee. And it's quite interesting, this reference to an arm's length arrangement, because that covers not just where the interest rate per se is excessive, but also the situation where the amount lent is actually excessive. I mean, if you lend, say, $1 million to your subsidiary, that may not be too bad, but if you lend $1 billion to your subsidiary, then maybe that whole arrangement is perhaps questionable. The Malaysia-UK DTA, on top of this, also has its own specific anti-avoidance provision, which says that the provisions, the reduced rates, should not be applicable if the main purpose of the creation of the debt was to take advantage of the article. And to my knowledge, there are no reported cases on this, and I do wonder how one would determine what the main purpose was. And I think also when we're talking about interest, it's worth mentioning the transfer pricing guidelines in passing. And dividends, much like interest, enjoy withholding tax, although I would reiterate the point that I've made. Under Malaysian domestic law, there is no withholding tax on dividends, so please, when you pay dividends to your foreign parent companies, don't start deducting withholding tax. On a general point, for countries that do have dividend withholding tax, you will often find that the reduced rates will vary depending on the shareholding size. The bigger the size of the shareholding, the more favourable will be the reduction of the rates. And the final point, the need for beneficial ownership. I mean, royalties, much like interest, much like dividends, the treaties will offer reduced rates. There's the need for beneficial ownership, and where you're using reduced royalty rates in Malaysia, you'd want to ensure that you have a certificate of residence from the payer. Technical fee articles are becoming more common in Malaysia's DTAs. They're certainly not in all of the DTAs, but most of the modern DTAs seem to include a technical fees article, and these will invariably reduce the Section 109B rate of withholding tax. I think it's important to note that the beneficial ownership requirement applies here, so I think one would want to be wary of any conduit structures. Also, if you're using treaties to reduce withholding tax rates on technical fees, you would again need to have a certificate of residence. Okay, I've muttered or mentioned a lot about beneficial ownership. Perhaps in terms of what it actually means, I can draw your attention to the Endo Foods case. Now, as you might have sussed from its name, the Endo Foods case involves an Indonesian group. I think that perhaps at the outset what I should say is that this case is interesting in that although it's essentially a tax case, it doesn't involve any tax bodies, it doesn't involve any tax authorities. Okay, but what happened in this case? Endo Foods was an Indonesian company that wanted to borrow money from the international bond market. It set up a structure, which I'll run through in a minute, which involved a Mauritius company. And at one stage, Mauritius had a very favourable tax treaty with Indonesia. And amongst other things, that tax treaty reduced the rate of interest withholding tax. But the Indonesian tax authorities unilaterally decided to terminate the treaty with Mauritius. And this would therefore have meant that the interest would have been subject to the full Indonesian rates of withholding tax. Now, the loan agreement included a clause that allowed for early termination if there was a change in law which increased the withholding tax above 10%, and such obligation could not be avoided by the issuer, i.e. the Indonesian group, taking reasonable measures available to it. Now, what had happened, having entered into the loan agreement several years beforehand, the rates of interest offered in the markets had fallen. So Endo Foods actually wanted to exit the loan. They wanted to go for an early redemption. So in a way, the termination of the Indonesia-Mauritius tax treaty was quite timely for them. And they argued that on the basis of this unilateral action by the Indonesian tax authorities, they should be able to repay the loan. So before I go any further, I'll just show you with the aid of a picture what the structure looked like. You had the Indonesian company routing its loan through the Mauritius company, which accessed the international bond markets. And what the trustee, JP Morgan Chase, argued was that the group should simply substitute the Mauritius company with a Netherlands company, because the Netherlands treaty with Indonesia also offers good rates. But as I said, Endo Foods didn't want that because they wanted to exit the bond, because they could get better interest rates elsewhere. So what you then had was Endo Foods and JP Morgan Chase going to a UK court to talk about essentially an international stroke Indonesian treaty issue. Because the issue that they went to court on, they went to the UK court on, was whether it was reasonable to put in a Dutch company, and that all turned on the issue of whether it could be said that the Dutch company would have beneficial ownership of the interest, this being a requirement to access the treaty benefits. So if we jump to what the UK's Court of Appeal said, they essentially found in favour of Endo Foods. They said that under the arrangement, the Netherlands company would have just essentially been a conduit. It had no right or enjoyment to the interest income. If the interest came in, then it went out again. So the UK court said, you don't meet the requirements on beneficial ownership. And this is perhaps one of the best guides we have on what is beneficial ownership. To me, it's slightly ironic that you get a UK court ruling on a tax issue and you don't have any of the tax authorities in the court. But that's what happened. Okay, the final point that I will go through in the last couple of minutes is the other income. Now, a number of treaties have something in them called the other income article. This article essentially says that items of income not expressly mentioned in the treaty are subject to tax only in the recipient's country of residence. And you would think that that could be quite a good defence in relation to section 109F. But what I've given you is only the first part of the other income article, because quite often there's a second part to the other income article that says, although other income is only taxable in the recipient's country of residence, if such income is deemed to be sourced in the payer's country, then it's still subject to tax. And of course we have section 15B, which in many cases makes 109F income sourced in Malaysia. So it's not really going to be, in many cases, that there's going to be that much comfort given by treaties. Although arguments can be based on the Teal's case that such income may be business income anyway, and then in the absence of a permanent establishment, the income wouldn't be taxed. So this concludes my whirlwind tour of double taxation agreements and how they interact with Malaysian domestic obligations. I think we'd be happy to hand back to the presenter.